External stability. Dixon defines external stability as an aim of government policy to promote sustainability on the external accounts so that Australia can service its foreign liabilities in the medium to long run and avoid currency volatility. There is no single measure of external stability. However, the current account as percentage of GDP is commonly used. The first three measurements of external stability, current account, net foreign debt, and net foreign liabilities, are all a percentage of GDP. That is, the dollar value over the total sum of expenditure on domestic output by households, firms, the government, and the foreign sector in an open economy. We use this measure as it provides the most accurate comparison across time and between countries. The alternative method will be to give the raw numbers, i.e. $5.6 billion, but we have no idea what that is compared to the economy's entire output. The first measurement of external stability is the current account deficit, or CAD, as percentage of GDP. It is the value of non-reversible transactions between residents and non-residents over a given period of time. This is from the balance of payments. It comprises our trade balance, which is our net goods and our net services, and the net income balance, which is the primary income, which is returns and factors of production, and net secondary income. The next measurement is net foreign debt as a percentage of GDP. These are loans owned by Australians to foreigners, less loans owned by foreigners to Australians. Now, this form of finance has the obligation to pay interest and repay the principal, i.e. the original amount. Foreign debt can be classified as either public, i.e. government, and private. The third measure is net foreign liabilities as a percentage of GDP. Now, liabilities is debt plus equity, and it's equal to the total financial obligation to foreigners less obligation of foreigners to Australians. So let's put these first three measurements into practice. In 2014-15, the GDP, i.e. the sum of expenditure on domestic output by households, firms, the government, and the foreign sector in an open economy, was about $1.7 billion. In this period, the total value of the current account deficit was about $57 billion. Now, this number is hard to compare, so as a percentage of GDP, it is negative 3.6%. To calculate it, we literally just put the current account deficit over GDP and times it by 100. We can now compare this to other time periods and other countries. We do the same for net foreign debt and for net foreign liabilities. Now, with net foreign debt, it's often divided into the public and private debt, and it can be seen that most of Australia's foreign debt is from the private sector. Another measurement of external stability is terms of trade. The terms of trade is the ratio of export and import prices. It is calculated by dividing export price index over import prices and timesing this by 100. If the index increases, it implies that Australia is receiving relatively more for its exports. An increase in export price relative to import price implies that Australia is better off, so we want the terms of trade to increase. Exchange rate is another measure. Exchange rates are the prices of one currency in terms of another. Now, it's not necessarily the exchange rate, rather the fluctuations in the exchange rate that can indicate external instability. The volatility can be attributed to Australia's heavy reliance on commodity prices, such as iron ore and coal, and or increased global economic instability. The final measure of external stability is international competitiveness. The OECD defines this as a measure of a country's advantage or disadvantage in selling its products in international markets. International competitiveness can decline with an appreciation of the Australian dollar because our exports are now more expensive to foreign markets and thus exports decrease. So, what are the trends? Let's first look at the current account balance from the Reserve Bank of Australia, RBA. The current account balance in blue is the sum of the trade balance, which is the orange, and the net income balance, green. It can be seen that the trade balance, i.e. goods and services, is the most volatile and impacts the overall outcome of the current account balance. Now, this volatility comes from commodity prices of exports, iron ore and coal. Now, this graph shows that the current account balance in Australia has fluctuated between -2 and -7% of GDP and is currently at about -3% of GDP. Now, let's look at the net foreign liabilities, the black line. Net foreign liabilities is the sum of net foreign equity, the blue line, and net foreign debt, two shades of pink. For debt that is borrowing money and need to repay interest and the principal, it can be seen that in the long-term debt, i.e. greater than 12 months, has slowly increased since 2001 from 20% to 50%, while short-term debt, less than 12 months, has slowly decreased from 16% in 2000 to 3% in 2017. While net foreign equity, i.e. giving up a part ownership, has gone from 13% in 2000 to -1% in 2017. This means we Australians own more foreign equity, i.e. ownership, than foreign ownership of Australian assets. This is a good thing. Thus, most Australians' net foreign liability is from net debt and not from net foreign equity. Let's continue with the trends. If we look at Australia's terms of trade, that is a ratio of our exports and import prices, it increased substantially from 2002 to 2011, which means we are receiving relatively more for its exports, and this is good. After the peak, it dropped in 2015-16 and is now bouncing back. This shows strong external stability. Riley notes that a rise in the terms of trade provides significant stimulus to aggregate demand through rising incomes, increased investment and government taxation revenue. While Australia's exchange rate as TWI appreciated from 2006 to 2012 too. As following 2012, the Australian did depreciate slightly, but like the terms of trade has bounced back. Australia's currency is generally stable, which reflects strong external stability. It should be noted that an appreciation of the Australian dollar does impact Australia's exporting industries, education, tourism and agriculture, which does decrease our international competitiveness. So, the positive and negative causes and effects. So some of the causes, according to Riley, of increasing external stability are growth in foreign borrowing, specifically public and private, during the 1980s, high public sector borrowing in the 1980s and 1990s. There was a shift from equity finance to debt financing during the 1980s. This was after the deregulation of the financial system. Higher inflation and lower international competitiveness in the 1980s. Falling commodity prices in the 1980s and 1990s. The saving and investment gap getting bigger. The lowering of protective barriers to trade, e.g. tariffs and exports, which led to increasing imports. A depreciation of the Australian dollar against the US dollar in 2000-2002, which increased our foreign debt repayments. The drought in Australia in 2002 and 3, reducing agricultural exports. Persistent and increasing current account deficit. And consistent federal budget deficits. So these are the causes. But what are the effects? Well, according to Riley again, some of the effects are we have a persistent CAD, which are financed by foreign debt and equity, which increases the size and servicing costs of net foreign liabilities in the future, leading to large net primary income deficit in the current account. It increases the exposure of the Australian economy to external shocks, which may reduce export income and increases servicing costs. It reduces confidence in foreign investors investing in lending less in Australia and or rising interest rates on these debts. There's increased volatility of exchange rate fluctuations, which leads to the valuation effect on foreign debt. There is a depreciation of the dollar, increasing imports and thus inflation. There's increasing high levels of net foreign debt, maybe downgrade our credit rating, making future borrowing more costly. And tighter monetary policy to slow down economic growth to reduce demand for imports. This may lead to falling output, investment and higher unemployment. So, to conclude, external stability is an aim of government policy to promote sustainability on the external accounts so that Australia can service its foreign liabilities in the medium to long run and avoid currency volatility. There is no single measure, but the best is current account deficit as a percentage of GDP. Other measures include net foreign debt as a percentage of GDP, net foreign liabilities as a percentage of GDP, terms of trade, exchange rates, and international competitiveness. The trend has been for a continual current account deficit, a stable net foreign liabilities, and a fluctuating terms of trade and exchange rates. And there are both positives and negative effects of this.